Welcome. The month-end close is the single highest risk point in financial reporting, so it cannot rest on goodwill alone. It needs clear ownership, strong controls, honest risk awareness, and measurable performance. In this section, you will learn who does what across the close, the preventive and detective controls that protect the numbers, the risks that cause restatements and enforcement actions, and the key performance indicators that tell you whether your close is healthy. Think of this as the structural framework that holds everything together. Let us begin by setting out what you should be able to do when we finish. Why start with objectives? Because a reference-heavy section is easier to absorb when you know what you are aiming for. By the end, you will be able to map close responsibilities across the chief financial officer, the controller, every accounting function, financial planning and analysis, tax, legal, internal audit, and the external auditors. You will distinguish preventive controls that stop errors before they happen from detective controls that catch them afterward. You will recognize the high-risk failures that lead to restatement and trace each one to its root cause. And you will read the close key performance indicators that reveal velocity, compliance, quality, and risk. Let us start with who owns the close. Who is ultimately accountable when the numbers go out? At the top sits the Chief Financial Officer, or CFO. The CFO signs off on the complete close, reviews and approves the board and audit committee packages, signs the Sarbanes-Oxley 302 and 906 certifications, approves the MD&A, makes the going concern conclusion, and leads the audit committee discussion. Reporting into that is the controller, who owns the close calendar and status tracking, signs off on the adjusted trial balance, reviews all manual and topside journal entries, reviews the flux analysis, and ensures every reconciliation is complete and signed before the period is locked. Leadership sets the tone, but the work happens in the functions, which we turn to next. Where does the detailed close work actually get done? Across specialized accounting functions, each owning a slice. Revenue and accounts receivable accounting handle revenue cutoff, unbilled receivables, deferred revenue, and the subledger to general ledger reconciliation. Accounts payable and payroll accounting own expense cutoff and accruals. Cost accounting reconciles inventory and cost of goods sold. Fixed asset accounting runs depreciation and amortization and reconciles the fixed asset register and intangible asset register to the general ledger. Treasury handles bank reconciliations and fair values, while intercompany and consolidation resolve out-of-balance positions and prepare the consolidated trial balance. Each function is a link in the chain. Beyond accounting, several support functions complete the picture. Who challenges and assures the numbers once they are prepared? Financial Planning and Analysis, or FP&A, owns variance analysis, the bridge analysis, the key performance indicator dashboard, and the board reporting package. Tax prepares the income tax provision, the deferred tax roll forward, and the tax note. Legal assesses contingencies, coordinates legal letters, and reviews the MD&A internal audit, reviews journal entries for fraud indicators, samples reconciliations, tests internal control over financial reporting, and reports findings to the audit committee. Finally, the external auditors, regulated by the Public Company Accounting Oversight Board, perform quarterly reviews, the annual integrated audit, and issue the going concern and control opinions. With ownership clear, let us see how controls protect the process. If you remember only two controls from this entire section, make them these. The close is the highest risk point for earnings management, management override, and misstatement, and it is the most scrutinized area for auditors from the Public Company Accounting Oversight Board. The two non-negotiable requirements are, first, the separation of journal entry preparation from approval, so no one can both create and bless their own entry, and second, the independence of the reconciliation function, so the person checking an account is not the person who posted to it. Everything else builds on these two foundations. Around them sit two broad families of controls, which we will look at in turn, starting with prevention. How do you stop errors before they ever reach the statements? With preventive controls, which act as gates. The close calendar names owners and due dates before close begins. Subalgers lock down in sequence after cutoff is confirmed. Every manual journal entry above threshold requires independent approval, and topside entries require Chief Financial Officer review. Accounting estimates follow a documented methodology with sign-off, and legal contingencies are reviewed with counsel before accrual. Every balance sheet reconciliation needs preparer and reviewer sign-off. Intercompany balances must agree before consolidation proceeds, and no period is locked in the system without controller sign-off. Prevention is powerful, but it is never perfect, which is why we also need to detect what slips through. What catches the errors that prevention missed? Detective controls, which look back and surface problems. Close calendar completion is tracked, with escalation when deadlines slip. Manual journal entries are scanned for fraud indicators such as unusual accounts, late entries, and large round numbers. Flux analysis tests every account above threshold before the trial balance is finalized, and clearing accounts are confirmed at zero before the period is locked. A reconciliation sign-off summary confirms every account has a signed reconciliation, and an intercompany out-of-balance report runs before consolidation. Subsequent events are reviewed from period end through the issuance date, and tags for the extensible business reporting language are validated before filing. Even with strong controls, specific risks remain, so let us name them honestly. What are the two most common ways a close overstates income? First, revenue recognized in the wrong period. When billing runs ahead of delivery and cutoff is not applied rigorously, revenue is overstated in the current period and understated in the next, carrying real securities and exchange commission enforcement risk. Second, accruals that are not complete. When invoices arrive after close and there is no systematic accrual process, expenses and liabilities are understated and income is overstated. Both are rated high risk for good reason, because both directly inflate reported earnings. The fix in each case is stronger controls around cutoff and accrual completeness. Next, we turn to a more deliberate danger: management override. Why do auditors treat management override as a significant risk by default? Because leaders can post entries no one else reviews. When there is no independent review of manual journal entries, the controller or chief financial officer can post unchecked, opening the door to fraudulent entries and misstatements. Closely related are topside entries with insufficient documentation, which make consolidation adjustments untraceable. Two structural risks compound these. Intercompany positions that are out of balance at consolidation cause eliminated balances to disagree and consolidated figures to be wrong, and subalger to general ledger differences that are never investigated leave balance sheet amounts unsupported and invite audit qualification. Each one is high risk. Beyond override, several disclosure and timing risks deserve attention. What goes wrong even when the core numbers are right? The disclosures and the timing. If management changes a methodology without treating it as an accounting estimate change, the result is an undisclosed change and Securities and Exchange Commission comment letter risk. If a legal contingency that is probable and estimable is not accrued, liability is understated and income overstated. If going concern is only assessed at year-end, conditions arising mid-year go unflagged and the auditor may qualify the opinion. And if the close runs long, a missed filing deadline can trigger delinquency, a trading halt, and regulatory penalties. Awareness here is the first line of defense. A final cluster of risks concerns consistency and what happens after period end. How can a technically accurate close still cause harm? Through inconsistency and gaps after the numbers are set. When the MD and A uses different language from the board package, the mismatch creates enforcement and legal liability. When an error requiring restatement is not identified, Because the analysis under the relevant guidance is not applied, prior statements lose their reliance and a public filing is forced. When subsequent events are not reviewed through the issuance date, required disclosures are omitted, and when flux analysis is skipped or superficial, errors slip past the final quality review. Spotting these patterns protects both the company and the reader. With risks mapped, the question becomes how you measure whether your close is performing, which is where the indicators come in. How do world-class finance teams know their close is healthy? They measure it. Close key performance indicators, or KPIs, fall into four themes. Velocity is tracked by close cycle time, with a target of 7 business days from period end to management accounts. Compliance is tracked by the reconciliation completion rate by day 5 and the share of manual journal entries with documented independent approval. Quality is tracked by accrual accuracy and the magnitude of audit adjustments against materiality. And risk is tracked by uncorrected misstatement accumulation, the close rework rate, MD, and a revision rounds, and going concern timeliness. Tracked monthly, these indicators turn the close from a hopeful exercise into a managed process. Let us pull the threads together. Let us bring it together. The close holds together when four things are in place. First, clear ownership, from the chief financial officer and controller down through every accounting, support, and assurance function. Second, controls anchored by the two non-negotiables of separating journal entry preparation from approval and keeping reconciliation independent, supported by preventive gates and detective checks. Third, honest risk awareness, knowing the high-risk failures from wrong period revenue to missed filings and what causes each. And fourth, measurement, through key performance indicators spanning velocity, compliance, quality, and risk. Carry these four pillars into every close you touch. Thank you for completing this section on controls, risks, KPIs, and responsibilities.